Hello and welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We're giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
If we would lower the interest rates by 1 point, we'd pay about 1 point less. That's $300 billion a year. Can you believe it? 1 point. If he'd lower it by 2 points, we'd pay $600 billion a year less. That's for years, 10 years, 12 years, whatever we make it. But we can't get this guy to do it. And the fake news is saying, oh, if you fired him, it would be so bad. It would be so bad. I don't know why it would be so bad, but I'm not going to fire him.
This morning it's probably the tariffs, just because it's so wide-ranging. If that's the expectation that you're going to go back to, imposing a unilateral tariff, in addition to still relatively high and restrictive tariffs on imports from China. We still don't know the details of what the agreement was from the talks in London, but if it is indeed a 55% tariff on imports coming from China, it's still a pretty steep increase relative to where we were before everything pre-Liberation Days.
I think in this case, they're reportedly, the crew did call back with a Mayday saying we've lost power. And it looked like, from the videos, it's like candid camera everywhere nowadays. It's sort of this pancaked into the neighborhood. So they'll be looking at things like fuel. They'll be looking at things like pilot records. They'll be looking at maintenance records.
We got 1 hour to go until the market close, so let's take a look at the major averages here. We've got the Dow hanging on to gains, up about 89 points right now, 0.2%. The S&P 500 up about 1/3 of 1%. The Nasdaq Composite up about, call it 1/4 today. And so investors are trying to figure out what's going to be happening next on the tariff front. President Trump saying he's going to come out with some kind of list of tariffs. That's been percolating through today. But otherwise, not any big headlines to decisively move.
Yeah, we had economic data, Julie. That inflation print was interesting. PPI, tame, benign, pick your adjective. Yeah. But like CPI yesterday, I did see some economists kind of scratching their heads about that. The economist David Rosenberg telling his clients maybe what you're seeing there, Rosie was saying, was some early signs that it's actually profit margins, not final prices here that are feeling the tariff heat.
Right.
But we got some smart economists we'll talk about that more with. After that inflation data, you did see the president weigh in as well. President Trump, once again, putting that pressure on the Fed, on Powell. They should be cutting, he says. He did also note that he's not going to fire Powell. Not going to fire him.
Right.
So you got that going for you.
He can't. Yeah. Legally, according to the Supreme Court and Jay Powell and the lawyers, et cetera. But in any case, one of the other things that we should talk about today was the big 30-year auction that we were looking ahead to, $22 billion worth of the long bond, as it's called, and demand was a little bit better than estimated, or at least not.
You had solid auctions,
right? And there's been concerns about it because of the deficit concerns surrounding this big tax bill. So with that auction being better, you see buying of treasuries and you see yields going down.
You didn't see that in the 10-year.
That's right.
Or the 30.
Yeah, exactly. So a little bit more reassuring for the market. And then elsewhere, a couple other things we got to talk about here. And I'm going to start with the Dow today. I know we tend to look at the Nasdaq 100, but we have to talk about a couple of movers in the Dow in particular. One of them, Boeing. Of course, we had that crash of that Air India jet, which was a Boeing plane. It doesn't seem like that there is speculation at this point that it was necessarily the fault of the kind of model of the plane. Nonetheless, because of that sort of headline risk and because of the history of Boeing, as we know, the stock going down about 5% today. So that's one of the things weighing on the Dow. And then the other one I wanted to mention, not in the Dow, but in the Nasdaq 100. I'm going to equal weight it again here so you can see it nice and crisply. But can we see it nice and quick? I'm looking for Oracle. Where's Oracle for me?
While we look, it has had a tremendous move. Going into that print, it was actually only up about 7% this year, but they printed, they guided, and clearly a lot of investors liked what they saw and are believers in Larry Ellison and Safra Katz and their overall role in the broader cloud story.
Yeah, where's my Oracle?
You'll just have to
Josh?
Trust us.
Is it not in the Nasdaq 100?
It's a powerful move.
It's a powerful move.
You'd be impressed if you saw it. out.
Okay.
All right, for more on the latest market moves, let's welcome in here Art Hogan, B. Riley Wealth Chief Market Strategist. Art, it is great to see you. So maybe, Art, we'll start big picture here, because I'm curious, Art, what is the latest Art Hogan target, year-end target for the SPX, Art? Where are we?
Yeah, so our target's 6,200, which doesn't seem that aggressive in the here and now, but certainly felt aggressive back in April. So I would tell you this. I think we've done a good job of going from a defensive first quarter where everyone was piling into things like consumer staples, utilities, healthcare, gold, and treasuries, to where now we feel like we have a little more clarity around trade. And I think there's some consensus that eventually, whether it's the end of July or into August, we'll know what the rules of the road are there. And we've seen a nice rotation into tech, communication services, and consumer discretionary. I think that's been a healthy rotation. I think, though, that the economic data, not the data that we've seen this week, but certainly the data that we will see in the months to come, will start to reflect some of that uncertainty, that pull forward of demand for goods by both enterprise and consumers. And certainly, we're starting to see some of the hard data catch down to the soft data in terms of the weekly jobless claims, and certainly the non-farm payroll has gone from an average of 155,000 a month down to 132,000 a month. So we're going to start to see some economic data slow in the months to come. It's just a function of how much it slows before we get the benefit of some of the tailwinds, like perhaps a tax cut if that ever gets through Congress, and a lighter regulatory touch.
And so do we just get sort of a drift from here in the short term?
Well, Julie, I think what we're going to see is that once we get into second quarter earnings reporting season, which is just right around the corner, and that will be the first time that companies will likely give us guidance for the rest of the year. Remember, the first quarter was that reporting season where it was okay not to give guidance because we just didn't know what the end game was going to be in trade, so it was almost impossible. The second quarter will be a much better tell. I think that'll give us a better look into how close we are to earnings estimates for this year and going into next. And I think that, so until then, and there's a lot of things that come up in July, right? So we've got an artificial deadline for this budget bill, July 4th. We've got a July 9th, end of the 90-day negotiating period on tariffs. I think it's going to be one of those sort of wait and see June and July's, and then hopefully we'll work our way through some of that the tariff noise that's in the economic data now. Things like retail sales slowing because they were so strong in the first quarter. Import-export numbers falling off a cliff because there was so much pull forward in the first quarter. I think once we work our way through that, we'll likely re-engage and probably have a run into the end of the year, into the fourth quarter.
Art, one topic certainly getting a lot of attention today and being talked about, I'm interested to get your take, is dollar weakness. I'm curious, Art, to get your take why you think we're seeing that weakness, and also how it could play into that earnings season you were just mentioning. I mean, it is a tailwind, Art, is it not, for those American multinationals that are doing business overseas?
Yeah, great point there. When you think about the percentage of companies in the S&P 500 has risen to close to 50% that do more than 50% of their sales internationally, right? So, you make things in dollars and sell them in other currencies. You're a beneficiary of that weaker dollar. It certainly will start to show up in currency translation when we start to get earnings. Most investors tend to look through that as a short-term phenomenon, and the dollar certainly has been volatile this year. Came off the boil during the first quarter, and certainly has seen a downward trajectory. I think that's likely overdone, and I think at some juncture, passing a budget bill, knowing the rules of the road of the trade war, finding an exit ramp there, and certainly, as we sort of work our way through second quarter earnings reporting season, we'll probably see that firm up a bit. But in the here and now, and certainly for the second quarter, you're going to see those multinationals be a large beneficiary of that weaker currency.
Art, we were looking at yields a little while ago and looking at the fact that the Treasury auctions this week have been okay, right? It feels like it was very recent that there was a lot of concern about yields moving higher, about deficits, about the impact that the tax bill was going to have. That seems to have dissipated. Why do you think it has, and do you think that is still a potential lingering risk?
Yeah, that's such a great question. And I think that it was just 2 or 3 weeks ago where we were, pressing up to 4.68 yield on the 10-year and 5.16 on the 30-year. And everyone thought, because of the pace at which we got into those new highs, that we're going to continue on, and that was going to be it. And everything had to do with the fact that we had a Moody's downgrade, and we're increasing our debt, and we have to raise the debt ceiling, and our deficits, spending will continue for the next 4 years if this bill passes. And I think that has simmered down quite a bit. A couple of things technically that happened was the old high on the yield on the 10-year was 4.75. We didn't reach that. We made a lower high at 4.68, and we've come off that significantly. The same thing was true on the 30-year, and the auctions over the course of the last couple of weeks, including today, have gone very well. So I think that the Treasury market, gave us a bit of a scare, whether it was the bond vigilantes or just a real concern about just how we just can't balance our books as a federal government. That seems to have dissipated a bit. There was also this sort of, we'd rather invest in any place but the United States for a period of time, and I think that was way overblown as well.
So, Art, when you're talking to those B. Riley clients and they're saying, okay, bottom line, against this backdrop, how do I want to be positioned here? What are you telling them, Art? I know you're a fan of the barbell approach. What is the barbell?
Well, the barbell approach is balanced, right? So it's on one side, we really like this lighter regulatory touch is going to help both financials and energy. And I think that remains to be seen, but will likely be true this year. We also have been fans of industrials. On the other side of that, I think you can continue to equal weight, not overweight, but equal weight some of the high-flying technology names in the Mag 7. And I think that what we've seen has played out very well this year, into the second quarter, and I think will continue. I think that earnings growth in the S&P 500 still will largely be driven by the top 7 or 10 mega cap technology stocks that have earnings growth rates north of 30% and are still trading at relatively reasonable multiples unto themselves and to their history.
All right, great to see you. Thanks for joining us.
Thanks so much.
Well, Bitcoin briefly bounced back today following remarks from President Trump at Coinbase's State of Crypto Summit. In a pre-recorded message, Trump touted himself as the first crypto president and promised to make the United States a global leader in crypto. Yahoo Finance executive editor Brian Sozzi had the chance to sit down with Commodity Futures Trading Commission Chairman Caroline Pham with what could be ahead for the crypto industry and the future of the CFTC with upcoming Chairman Brian Quintes. Take a listen.
I'm so excited for Brian and for him to come and bring his leadership to the CFTC, and that's exactly why I wanted to make sure that we were able to do that spring cleaning and make sure that Ryan is able to hit the ground running when he comes in as permanent chairman, hopefully very soon. So I think it's going to be fantastic. He's had a very clear record as a commissioner that speaks for itself, and I'm looking forward to it.
The CFTC might get more responsibility for regulating digital assets under Brian. What do you say to the crypto bulls that would say things are going to be easy sledding regulatory-wise over the next 4 years or under the Trump administration? Is it be careful what they wish for?
There is no easy street for anybody, and the regulators aren't easy. So just because we are pro-innovation and pro-growth does not mean that you're going to be able to get away with breaking the law. And this is where I'm talking about not twisting the law to criminalize an asset class or a technology, but I'm talking about lying, cheating, and stealing. I gave a speech in 2022 where I said you can never commit fraud. Never. You can never steal from people. You can never lie to people. You can never cheat victims, right? And so that's what I've been pleased we've been able to do is end the regulation by enforcement decisively and be able to refocus our limited resources, time and attention on catching fraudsters and scammers in our markets, which we have done for decades. That's always been our core mission, is to prevent fraud, manipulation, and abuse in our markets, and to help victims. A lot of times the CFTC brought enforcement actions that were actually unrecoverable, right? We were going after fly-by-night websites in foreign countries where we knew from the beginning we were never going to be able to recover any money for victims, and they weren't who were these victims in the first place. We never had any of that identified, but we'd say, oh, look, it's a $500 million judgment. Well, that's just on paper. We didn't actually help anybody. There's plenty of poor people out there, people who have been taken advantage of, people who have been unfairly treated, they've been victimized, they've been scammed, they're here in the United States, and we need to be stepping in and using our authorities to make sure that they're getting actual recoveries. So that's actually one of the KPIs that I put into place, is to measure the actual recoveries that we've gotten and what's been distributed to victims, not just looking at a big dollar sign of a, fictional judgment that we'll never collect.
Along those lines, you also said on your panel, and I want to get your thoughts a little more on this, you have to Uberize crypto. What did you mean by that?
So one of the things that people have been really concerned about, right, is that the last administration, particularly with the SEC and the CFTC, really went beyond what the law says and what the statute says. Many of my dissents as a commissioner on our enforcement actions pointed out how we were reinterpreting existing laws that have applied to the derivatives markets, to futures and to swaps for decades. And this applies to the traditional markets. I'm not even talking about crypto. I'm talking about the interest rate swap market, the biggest, deepest, most liquid rates market in the world. I'm talking about the FX market. These things are critically important for companies all over the world and American companies to manage their risk associated with being multinational corporations, with making payroll in however many different currencies and however many different countries around the world, for the US government as well. So when we start to change the rules for actual, the 700 trillion notional global derivatives markets, because we're trying to be creative and flex it to go after what we perceive to be a bad or evil, crypto or blockchain, that is really breaking the fabric of our global markets. I feel this so strongly, and so that's why I've had all those dissents. All of those things were the existing laws on the books. That's our existing statute, those are the existing rules. The last administration ignored that. They ignored it to go and pursue novel enforcement theories, not caring about the unintended consequences of what that would do for the global economy and for global markets. So that's why many of these staff letters that I talked about have focused on restoring the well-settled legal precedents, how the CFTC has applied and interpreted the law for decades to restore that regulatory clarity. So what does that mean? That means no matter what the law says, somebody in the future can come along and ignore it. How do you make sure that that doesn't happen? And one of the things I said on my panel is that when something becomes so big, so accepted, so part of our lives, you can't really take it away then. The public, the people, voters, they won't let you. And so that's what I meant, because, a lot of people tried to fight Uber. But everybody had Uber in their pocket. People liked Uber. Uber did a lot of things to revolutionize the transportation industry. And so even when people tried to ban Uber, they couldn't. And so that's what I think is actually, if you want to talk about how do we make sure that crypto never gets unfairly criminalized as just a concept, as a technology. I'm not talking about, again, fraud. Fraud is always illegal. Those are criminals that deserve to be caught and punished and held accountable. So that's not what I'm talking about. I'm talking about just as a concept or as a technology, trying to criminalize it. The way that you do that is by bringing it to the people, and the people will speak, and voters speak.
Before I let you go, the people have also spoken, and they seem to like prediction markets. Now, I've talked to Robinhood CEO Vlad Tenev numerous times, and he has told me, we want to get big into prediction markets. Kalshire is already big in prediction markets. Should these markets exist?
Prediction markets have existed forever. If you want to think about what some of the first futures contracts are actually about, it's about predicting the weather. If you're a farmer, it's really important that you know if it's going to rain or not rain. So prediction markets have existed before, our current organized futures markets ever did. This goes back, I'm sure, hundreds, thousands of years, maybe even just imagine when the world was a barter economy and what people were doing back in the day. So they exist, they're real, right? And it's precisely because of things like weather derivatives that we've always had these prediction markets in CFTC regulations. We call them event contracts, to use more of a term of art. And so what I think is super informative and about the value of these markets and why they're important, and why I tried to reopen the comment period on a very thoughtful 2008 concept release. So the CFTC's been looking at this for 30 years, right? Because the first no action letter that the CFTC did around prediction markets was actually in the 90s. And then we did this concept release in 2008. Now, unfortunately, I don't have a majority on the commission, and sadly, due to partisan reasons, just reopening a comment period to get feedback from the public, right? From all members of the public who could have weighed in and said, do they think these things are good or bad, and what are the important considerations that we need to think about as regulators to be responsible about this innovation. That got blocked, so I wasn't able to do that. That's very unfortunate. But anyhow, These, the 2008 comment letters really focused on the information value of prediction markets, right? They're information markets. What's the most valuable commodity in the world? Particularly if you look into the future and you think about Gen AI. The most valuable commodity in the world is probably information. Real information, true information. So if you can use market forces, the self-policing, self-enforcing market mechanisms to divine what is real and what is not, that's what an information market does. And I think one of the key aspects to look at in the CFTC's statute is that the national public interest, which is very clear, Congress very clearly laid out a public interest for us, it is to have these national markets that provide price risk management, price discovery, and price dissemination. And that's exactly what markets do. Markets use pricing mechanisms of the market to disseminate information. Every time you look at a stock price, you have taken all of the information available about that company, about its revenues, its cash flows, its product, its management, its strategy, its capital investments, the entire, chapter and verse, A to Z of that company is expressed through its stock price, through the power of markets. So it's the same thing.
Well, trash has been good for investors this year. The biggest player in the industry has risen 17% year to date. It's trading near a record high. That compares with a less than 3% gain for the S&P 500. We're talking about WM, the company formerly known as Waste Management. We've been focusing on stocks like this that have been overperforming amid a volatile year for our series, The Why Behind the High. And we're joined now by WM CFO Davina Rankin. Davina, thank you so much for being here.
Happy to be here and happy to be part of this segment in particular.
Yeah, I'm sure, given the performance that you guys have been seeing. For people who aren't that familiar with WM, sort of big picture, tell us what an investor can expect from the company. My sort of impression of your industry generally and you guys specifically is pretty steady business, right? Everybody needs their trash removed, both residential and commercial, and business that probably generates a good amount of cash.
Yeah, that's a great synopsis. What I would say is we're an essential service, and that means that we're resilient. We do well in any economic environment and any political administration. So when people are looking for a safe place, we're often thought of one of those places to park money in uncertain times. What I would say is we go beyond that, though. We're also a growth engine, and that growth comes from strong execution from top line to bottom line in terms of how do we grow our markets organically, how do we grow through price, cost optimization, leveraging technology in order to optimize our cost to serve, and thinking about scaling our business both in our core, but then also in things like healthcare solutions and renewable energy.
I want to show folks a chart of the revenue growth you guys have had over the past decade or so by year, as well as EBITDA growth. And again, it has been that pretty steady growth that we've been talking about. But within that, what would you say, looking forward, are going to be the biggest areas of growth for the company? And you mentioned medical, for example. I know you guys recently completed a big acquisition in that business. Is that where investors can expect that sort of growth to be a little more supercharged?
Yeah, so I think it's important to look at our history and put our history into really solid context for purposes of where we go from here. What we have done generally over the last decade is grow EBITDA. Our target had been 5 to 7% annual EBITDA growth over the last 10 years or so, and we've meaningfully outpaced that. Our EBITDA growth in the last 3 years has been 9% on average. And when we think about what lies ahead, it really is a supercharging, and that supercharging comes from that core solid waste growth that we've had a consistent track record of being able to generate, and then the strong integration of the healthcare solutions business, the Stericycle acquisition that we completed in November of 2024. That integration's off to a great start, and it's really scaling WM's expertise in materials management to a new segment of the economy. On top of that, we are a sustainability leader. That means that what we do goes beyond picking up your waste from the curb and taking it to a landfill. We're the largest recycler. We're also the largest generator of renewable natural gas from landfills in North America. So those things are creating economic value and environmental utility, which we think will spur incremental growth over the next 10 years.
And it's my understanding, Davina, that you all still have some money set aside for more acquisitions, right? So I'm curious where you see those opportunities and what kind of cadence you would look for in terms of, how you want to add on those other opportunities.
Sure. So one of the great things about this business is that we generate strong and consistent free cash flow. Over the next 3 years, we expect to generate approaching $10 billion of free cash flow. So when you think of that combined with a solid balance sheet, we certainly have room for incremental M&A. We look to the core for M&A opportunities, but as the largest in this space, those opportunities can be limited in some respects, but we will continue to focus on where we can complement our market positions and extend them even further. Beyond that, I think the step that we're taking with the Stericycle acquisition indicates that we're going to look at adjacent growth as well. Where can we take our core competencies and extend them to other parts of the business?
You also mentioned, sort of taking out costs as part of the equation. And one of the ways you guys have done that is automating some of your business, particularly at recycling facilities. Can you tell me what percentage of those facilities have been updated with that and kind of what the target is there and how much that's going to save the company?
Yeah, so we are investing $1.4 billion over a 5-year period in upgrading and expanding our recycling network. It's been something that we've been working on the last few years and will be substantially complete with that by the end of 2026. At this point, we've invested 85% of that planned capital. But we see things like end producer responsibility as something that may extend that investment portfolio from here. So we're really excited about what we've accomplished. When we've made those investments, what it does is it expands recycling access to more communities. On top of that, it creates more viability, long-term sustainability of recycling as a service because it reduces labor dependency. And those are jobs that are really hard to fill. So we've reduced our labor costs by upwards of 30% at our facilities. And there's more work to do across the network, but we're substantially complete with the investment that we announced a few years ago and really happy with both the expansion of recycling access and the improvement to recycling profitability that's happened with those investments.
You mentioned labor, and I have to ask about what we have seen unfolding across the country as of late. We've been talking to a lot of economists on the effect that the immigration crackdown is going to have on employment overall. And when I think of less skilled labor, your industry is one of those that I think of. We were just showing video of, the trash truck moving through the neighborhood. Is this something that's affecting your business? How are you guys thinking about it?
What's really important is first, I want to sing the praises of our drivers and our technicians because, it really is a skill. And so we don't think of our workforce as unskilled at all. They are industrial athletes who make what they do look easy, but it is anything but. And we have drivers who have worked for us for decades, and we appreciate and celebrate everything that they mean to us and to our communities and customers each day. We're happy to say that the immigration policies of this administration have not had an impact on our business, and we don't think that they will. We are a people-first organization focused on investing in our talent and ensuring that our talent feels like they're part of an organization where they want to spend not just years, but decades.
Davina, thanks so much. And by the way, investors, we'll hear more from you guys on June 24th. You got an investor day scheduled, so we'll be tuning in for that as well. Thanks so much.
Thank you.
Well, investors shifting their focus back on the Federal Reserve ahead of the central bank's policy meeting next week. President Trump once again calling for Fed Chair Powell to cut rates. For more on the path ahead for the Fed and interest rates, let's get now to Loretta Mester, University of Pennsylvania adjunct professor and former Cleveland Federal Reserve president. Loretta, always good to see you. So let's start, Loretta, with that inflation report we got today. PPI, tame, Loretta, benign, just like CPI yesterday. I'm very curious to get your take on that. And also, Loretta, how you think the Fed views these last two inflation reports.
Well, thanks for asking. Yeah, the inflation news, those were good reports. They were very encouraging. I think what's still true is we don't know really how the second half of the year is going to play out. So if you look at the data on the employment part of the mandate, data on inflation, they look pretty good so far, right? Employment's holding up. We expected moderation this year. We're seeing some of that. And inflation, was pretty elevated at the start of the year, but the last couple of reports have looked pretty good. It's still above the Fed's goal, but at least it's coming down again, and that's a good sign. But the real question is, what is going to happen in the second half of the year, and will those trends continue? And that's where the high level of uncertainty still is with us. And that, I think, is why the Fed is on hold until some of that, we get a little more clarity about not only the magnitude of the tariffs and the breadth of the tariffs, but what effect they'll have on inflation and what effect the tariffs and other policies, including the budget bill, will have on growth and employment. And so that's why, when you think about the Fed managing its dual mandate, part of what it wants to do is it wants to minimize the chance of any policy mistake. And that risk management also entails, looking at, well, what would be the cost of a mistake? So right now, holding the Fed funds rate where it is doesn't seem very costly, and allowing sort of more clarity in the summer about, we'll get perhaps more clarity on the tariffs. And we could end up being in a benign scenario so that by the September meeting or later in the year, right, it does look like inflation is continuing to come down. Perhaps it'll be higher for a time as higher prices from the tariffs, feed through the economy, but it won't necessarily be persistent. And that's kind of what everyone hopes. Everyone hopes it's a more benign scenario so that we get some clarity on the level of tariffs. Firms raise their prices, but as those prices stabilize, inflation moves back down, and there's not much harm on the growth side of the economy or the employment side of the economy. And that's kind of the hope, but that isn't assured, and that's
Right.
why it makes sense to sort of be on hold for a while until you get more information.
So I guess if they get more information, when will they be comfortable is the question. In other words, if we continue to see reads say, like we saw, this week, does that, how many of those do we need before the Fed will have a comfort level and say, okay, maybe we can go ahead with the two cuts that were modeled on the dot plot, for example, before the end of the year?
Right. So I think we're going to need to get through the summer because remember, early in July is when we're supposed to have the 90-day reprieve go off. We don't really know what happens after that. And there still seems to be some negotiations going on with other countries. We don't know how they're going to turn out. We don't have much details at all on China, although it was good that we got some clarity perhaps with the announcement that we're kind of done with that. But we'll see. We've heard that before, and then things don't work out that way. So I don't see, and given where inflation expectations are, right, we've seen especially among consumers and businesses, those shorter run inflation expectations have moved up, which I think has to cause the Fed to want to be cautious because, I said the benign scenario. Well, there's another scenario out there that would be a very bad scenario, and that would be tariffs go up, stay high, prices go up, there's tit for tat, still continuing negotiations, prices go up again, and that increase in prices leads to inflation expectations being destabilized. And then, we have a real inflation problem again. And so that's what the Fed wants to avoid and needs to avoid. So they're right to prioritize that now until there's more information. And then come the fall and later in the year, if they gain confidence back that inflation is back to what it looked like it was doing at the end, in the fall of last year, they could go back to normalizing policy and bringing the rate back, the funds rate back down. But until they have some more confidence that that's the path, and that they can look through any temporary rise in inflation and that it will truly be temporary, it behooves them to sort of run the policy that they're on. And if it turns out then, okay, they get that clarity in September, or if it turns out, wow, the labor market seems to be weakening more than we anticipated, they can lower rates then, and they could lower them more aggressively than they would otherwise. So they're in a good, policy is really well positioned right now to react whichever way the economy evolves. They can either stay on hold for longer to get more comfort, or in the fall, if it looks like things are weakening, they can cut. And so I think they're in a good spot. Everyone's hoping that we get the benign scenario so that the Fed can go back to their normalization path that they started last autumn, but we don't have enough clarity around that to be able to make that be the right call. I think they're doing the right thing at this moment.
Loretta, thank you so much. Good to see you.
Hey, great to see you too. Thanks.
Coming up, we're taking a look into growing investments into U.S. manufacturing. More market domination on the other side.
Well, chipmaker Micron is investing an additional $30 billion in the U.S., bringing the total manufacturing and research and development investment up to roughly $200 billion. For more, we're bringing in now Yahoo Finance tech editor Dan Howley. Dan.
That's right, Josh. This investment is part of Micron's bid to expand their manufacturing inside the U.S. So one of the pieces of this includes a new plant in Idaho. They already have a plant that's under construction now in Idaho. This would be the second one there. They also have a mega facility that they're building in New York. They're still working the ground there, not necessarily getting things up and built yet, but preparing the ground. That would be 4 fabrication facilities. Fabrication facilities are just a place where chips are built. They call them fabs. Who knows why? And then also expanding their R&D. So there's places obviously in Virginia as well that they have that they're expanding here. Part of this funding, $6.5 billion, comes from the U.S. CHIPS Act. That's based on or meant to allow companies to expand their presence in the U.S., reshore some of the chip manufacturing here. And just to give everyone a kind of background, Micron produces memory, both random access memory as well as stable memory, stuff that you would store data on. And one of the other things that they produce is HBM, or high bandwidth memory, and that's regularly found in a number of the AI data centers that are used. NVIDIA leans on it, AMD leans on it. Anybody that's working in the AI space now uses high bandwidth memory. And Micron isn't the only company that produces it that manufactures in the U.S. SK Hynix, South Korean company, also has a facility in the U.S. And so, it's a big move for Micron, showing that more companies are building chip manufacturing in the U.S. The one caveat here, though, is while we are seeing more construction in the U.S., it doesn't mean that the U.S. is automatically becoming the biggest manufacturer of chips in the world. It's just building on what it previously had, obviously, kind of ensuring that it doesn't necessarily have to rely entirely on foreign-made chips, though they still will heavily.
Dan, you point out in your very good report, sir, that an interesting factor, which is that Micron is not the only company bringing HBM production to the U.S., high bandwidth memory. And SK Hynix is doing the same thing in Indiana. I am just curious, Dan, to get your take on that. Why all this interest in HBM specifically?
Yeah, this is the memory that goes into the chips that you would see from, say, NVIDIA, their Blackwell chips or their Hopper chips, or AMD. They just announced their new MI350 line of chips today, or launched them rather. They had announced them quite a while ago. But this high bandwidth memory is imperative for passing information back and forth when it comes to AI training models. And so that's really where it's shining. That's where it's going to go. That's where companies are looking to place it. And so I believe with AMD, their announcement was Samsung and another manufacturer when it comes to the HBM. But obviously Micron, a big name in this space as well. And there's plenty of demand for this kind of memory. And so you'll continue to see that be a huge component for these AI data centers going forward.
Thank you, Dan. Appreciate it. While we wrap up today's Market Domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.